You know what nobody tells you when you're sitting in that company orientation, filling out your benefits paperwork? That innocent checkbox next to traditional 401k? You didn't just sign up for a retirement account. You just gave the government an IOU on money you haven't even earned yet. Here's what I mean. Let's say over your career, you managed to save $1 million in your 401k. Congratulations! Except you don't actually have $1 million. You might have $650,000, maybe $700,000 if you're lucky. The rest? That's Uncle Sam's cut. And here's the kicker. You don't even know what that cut will be yet. The government gets to decide that number 30 years from now, based on how badly they need your money. I'm Clint the Investor, and I break down the financial advice everyone repeats without questioning. If you've been autopiloting your retirement contributions because someone told you it's just what you do, or if the phrase tax-deferred growth makes you nervous but you're not sure why, stick around. Hit subscribe because we're about to expose the hidden cost that could drain hundreds of thousands from your retirement. Let's talk about the deal you actually made. Traditional 401ks work on a simple promise: skip paying taxes now, pay them later when you withdraw. Sounds reasonable, right? Except this deal has three massive problems that nobody explains up front. Problem number one, you're betting the taxes will be lower in the future. Think about that for a second. We've got $36 trillion in national debt and climbing. Social Security is projected to run out of money in the 2030s. Medicare costs are exploding. Do you genuinely believe tax rates are going down from here? Right now, we're living in one of the lowest tax environments in modern American history. In the 1960s and 70s, top tax rates were above 70%. We've been in a tax sale, and most people are acting like these prices are permanent. If you saved 22% on taxes today, but pay 35% when you retire, you didn't win, you got crushed. Problem number two, the RMD ambush. Here's something that shocks people. Let's say you're disciplined, you save aggressively, you build up $2 million in your 401k. You retire at 65, thinking you'll just withdraw what you need. Nope. At age 73, the government forces you to start taking money out whether you want it or not. These are called required minimum distributions. On a $2 million account, that's roughly $75,000 to $80,000 per year that gets added to your income. Now here's where it gets brutal. That extra income pushes you into higher tax brackets. It makes more of your Social Security taxable. It triggers Medicare surcharges that can double your premiums. You end up in this nightmare scenario where every dollar you take out gets taxed at rates far higher than what you saved decades ago. You built the wealth, but you built it inside a tax trap. Problem number three, you have zero control. Congress can change the rules whenever they want. They've already done it. The Secure Act changed inheritance rules, making it worse for your kids. They can change the age for RMDs. They can change tax brackets. They can add surtaxes on wealthy retirees. Your money is sitting in an account that politicians 30 years from now get to make rules about. You're trusting future you to a system run by people who haven't even been elected yet. So what's the alternative? It comes down to a simple question. Would you rather pay taxes on the seed or the harvest? Let me explain. You plant $10,000 today. Over 30 years, it grows to $100,000. Would you rather pay tax on the $10,000 now or the $100,000 later? That's the difference between Roth accounts and traditional accounts. With a Roth 401k or Roth IRA, you pay the taxes up front. Yes, it stings. Your paycheck is smaller, but that money grows completely tax-free forever. When you're 70 and you pull out $80,000, tax bill, zero. If rates go to 50%, doesn't matter to you. Your tax rate is locked in at 0%. You eliminate the single biggest unknown variable in your financial future. Now, I know what some of you are thinking, But my company matches my 401k contributions. That's free money. You're absolutely right. Always take the match. That's a 100% instant return. Not taking it is like declining part of your salary. But here's where people mess up. They think that because the match is good, maxing out the traditional 401k is automatically the right move. That's lazy thinking. Once you hit the match, you need to get strategic. If your employer offers a Roth 401k option, switch your contributions there. If not, contribute up to the match in the traditional, then max out a Roth IRA. After that, consider a regular taxable brokerage account.
Wait, taxable brokerage accounts? Aren't those worse because you pay taxes every year? Not necessarily. Here's what most people miss. When you sell investments in a brokerage account, you pay capital gains taxes, not income taxes. Long-term capital gains are taxed at 0%, 15%, or 20%, depending on your income, way lower than the 22%, 24%, 32%, or higher you'd pay on 401k withdrawals. Plus, brokerage accounts are liquid. You can access your money at age 35, 40, or 50 without penalties. You're not locked into the government's retirement timeline. The wealthy understand something crucial. Tax diversification matters as much as investment diversification. You want 3 buckets in retirement: tax-deferred money, traditional 401k, tax-free money, Roth accounts, taxable money, brokerage accounts. This gives you options. If taxes spike one year, you pull from your Roth. If you have a low-income year, you convert some traditional money. You can engineer your tax situation instead of being at its mercy.
Here's what you need to do this week. Log into your retirement account. Look at your balance. Multiply it by 0.70. That's approximately what you really have after taxes. If that number makes you uncomfortable, you need to change your strategy now. Check if your employer offers a Roth 401k option. If they do, switch your future contributions immediately. The temporary reduction in your paycheck is the price of freedom from future tax uncertainty. If you're already sitting on a massive traditional 401k, talk to a tax professional about Roth conversions. You might be able to strategically move money from the traditional to a Roth during low-income years, locking in today's rates. Look, the traditional 401k isn't evil. For some people, in very specific situations, it makes sense. But the blanket advice to max out your 401k without considering your specific tax situation, your retirement timeline, and the macro environment is financial malpractice. We've been sold this idea that deferring taxes is always smart, but deferring isn't avoiding. You're not outsmarting the IRS. You're just procrastinating on a bill that might be way bigger when it finally comes due. With the national debt where it is, with the political environment we're in, parking 100% of your retirement in tax-deferred accounts is a massive unhedged bet. You're betting that politicians 30 years from now will be more generous and fiscally responsible than the ones today. I don't know about you, but I'm not willing to bet my retirement on that. Take control of your tax destiny now while you still can. Your 70-year-old self will thank you. If this changed how you think about your retirement contributions, share it with someone who needs to hear it. And hit that subscribe button. We're just getting started on exposing the financial myths that keep people broke. I'm the investor. I'll see you in the next one.